Don Rissmiller of Strategas. It's good to see you here at the Camp Kotok retreat in Maine.
It's very nice to be here.
And it's a great opportunity for people to get away from the office and kind of do some deep thinking. You've been thinking a lot about uncertainties and anxieties. What are the uncertainties right now, the biggest ones, do you think, for investors?
So one thing we've looked at is when we focus on capital spending, it correlates very well with CEO confidence. And in fact, CEO confidence tends to lead capital spending by about 3 months. Now, every year for the past 4 or 5 years, there's been some macro risk, and it hasn't just been in the U.S. We can go abroad and look at what's happened in Europe. It was Greece a few years ago. This year it was Britain. We could look at China. So there's been this concern that things that are supposed to be safe aren't quite as safe as we would like, or you're not being compensated for the risk that you take in those places. So that's affected planning. It's affected whether we do capital spending or share repurchases. And I'd say in terms of growth, one's better than the other in general. So what we'd like to see is a balance. And as long as things are uncertain, I do think there's a tendency for financial executives and others to do some things that may be responsible in the short run, but aren't going to lay the groundwork for future growth. So that's what we'd like to see change. Now, here, I think a lot of folks are kind of holding their nose and trying to move forward. It's not to say that the uncertainty has lessened completely, but I think we're getting a little more comfortable with what's gone on. The challenge going forward, I would argue, is if you had a toolkit and that included some of the policy tools, like monetary policy or fiscal policy, some of the arrows look broken, some of the tools look broken currently, or we're approaching the limit on monetary policy in particular. So there's a desire to raise interest rates a little bit in the U.S. Other countries are still interested in stimulating their economies. That would usually require cutting interest rates or doing more QE or other types of policies. And that divergence is still causing people some concern.
Do you buy into that argument the Fed has got to raise in case they have to cut?
Not really. If the equilibrium interest rate is rising, then I think the Fed should be increasing interest rates. If the equilibrium interest rate is not rising and you try to raise rates, you're actually going to lower your future equilibrium rate. And so you're going to cause a bigger problem than if you just did nothing. Or look at Japan in the last decade or so. It might have been better to try to stimulate more early and then leave things go and see how things develop. So
is the political cycle an uncertainty that is going to create more risk going forward now the next couple of months?
It will. It's well known at this point, so I'm not sure it should be terribly surprising the way some of these other international events this year have been. And I do think we can get a handle in the next few months by watching some of the polls, at least to get a framework on how to address this. I think the challenge has been, if we look abroad, say with the Brexit vote, some of the polls were way off. And in fact, the market the day before was way off in terms of its initial reaction going into the vote. So we have to be careful with some of the traditional metrics. But I do think we can get some sense over the next few months. Now, whether it's a two-party race primarily or whether some of these third candidates start coming in, that's going to matter too. We want to be careful with that, but it'll be over soon.
But the biggest risk for the U.S. right now is outside? Outside of the U.S., is that where the biggest uncertainties are coming from, whether it's problems post-Brexit with some of these other economies in the EU?
I think that's fair. If we look at some of the recent data, it's been okay. Here, GDP was not terribly good in the second quarter, but some of the drawdown was from inventories. It's likely we'll get a bounce in the second half for the U.S. economy. The last employment number was quite good. It's hard to find anything really wrong with that. And yes, there's the election, but if that's well understood, then some of the risk starts to come from abroad. And there are places like China which are still question marks. And part of this is the data is just not as good as you might like to do some good analysis. And we do have to watch Europe. So far, the Brexit vote looks mainly regional. So our UK GDP forecast came down 2 percentage points. After that, our US GDP forecast changed by 0.2 of a percentage point. So it's mostly regional and probably manageable. But we do want to watch Italian banks. We want to watch some of these other financial strains. But so far, so good again.
Don Rissmiller, great chatting with you.
You
Thanks
as well.
so much.
Thank you.